let's go ahead and we'll go ahead and start. So, you know, a lot of my people are here, and I think they think it's really funny that I'm up here on Spotlight and Ferrous, because the standard joke at the company is that my dog knows more about which direction the market is going than I do. And so, actually, Mary Beth, who's sitting right here, used to put a slide of my dog on the stage, you know, pointing up in the air to show which way she thought the market was going to go. Anyway, before I start, I just want to say that I think this is an incredible venue, and for all of the convention committee and all the people who put this thing together, I don't think we could find a better, prettier spot than Vancouver here. I don't think I've ever been at a convention hall that looked out over the water. They're always back away. Even when I did mine in San Diego, the convention hall wasn't on the water like this. I mean, this place is just spectacular. So, really appreciate everybody coming. Obviously, this is the Ferrous Spotlight. We got some great speakers today. We got some really entertaining people. Maybe we can remind everybody to shut their cell phones off. And also antitrust, you know, no specifically talking about prices, no asking about or making a comment like the price is going to go up or the price is going to go down. Jason can talk about the prices you know, because he's an analyst and it's what he does, right? And so, anyway, we're supposed to have bios, but I don't have bios yet. So we're going to let everybody kind of give their own little bio. So I'm George Adams from SA Recycling. And SA Recycling is located in the southwest United States. We run a bunch of different scrap yards and shredders and different stuff. And Jason is in Texas. Not that he's really from Texas, but he's in Texas. You can tell by the boots. And he lives there in Austin. And he speaks about 20 languages and is a really, really smart guy. But I'll let him give you his bio and we'll let him start.
Thank you very much, George. I really, really appreciate the kind words, the introduction, and the reference to my boots. Good. So I happen to have a presentation today, just a few slides to talk through some highlights for what we're expecting in the ferrous markets. Just to introduce myself briefly, as George said, we'll kind of do our own little bios. I think a number of you know Prestige Economics is a market research firm that I started 6 years ago in 2009. We do market research, reports, industry research for material handling, automotive, energy, and those things are also all really important for industrial metals and scrap. Also do different consulting projects, risk management, transportation, fuels, and procurement. We also have a pretty good track record for forecasting metals prices. So we've been top ranked in 9 different metals categories by Bloomberg since 2011. Each of our rankings is for 8 consecutive quarters of accuracy. So for all industrial metals, we've been ranked number 1, precious metals number 2, palladium, nickel number 2, lead, zinc, copper, aluminum number 3, and also for gold number 6. And we've been top ranked in 24 categories in total, and these are the 9 categories we've been ranked number 1 in. So although metals is what I'm here to talk about today, a lot of the things I look at and my worldview isn't just shaped by metals, it's shaped by what's going on macroeconomic policy-wise, what's going on with interest rates, what's going on with the Fed, what's going on with the dollar, what's going on with energy prices. We have an integrated view, and I personally do all of our writing and modeling. I don't make all the graphs, and I don't dig on all the numbers, and I definitely don't read all the SAP code when we do larger projects, but I personally have built all of our forecast models, so I'm quite pleased that we've had number 1 rankings in so many categories just since 2011. So I'm going to talk now about our expectations, but before I do, just sort of standard disclaimer stuff, and also to mention, I know we might have media here. If we do, just no part of the presentation can be quoted without speaking to me personally, so if you have a question and you want to quote it and you're with the media, you need to talk to me first. So, now that that's kind of out of the way, I want to talk about our expectations and what's been going on in the metals market and what you should expect next. And I know what y'all want to hear about is price, and I will get to that very shortly. But first, I want to point out what I consistently believe are the most important economic indicators out there. The purchasing manager indices, the PMIs, for what we have here is the UK, the Eurozone, China, and the US. You'll notice that they move together, and from top to bottom, if you look, and I know the colors might be tough to see at the back, but the light blue line that on the far right is at the top, that's the US. The darker blue line right below that one, that's the UK. The Eurozone is green, and the Chinese PMI is red. During the Great Recession, they all fell sharply. 50 is a break-even level. If the number's above 50, it means there's growth. If the number's below 50, it means there's contraction. The biggest things happen when these move together in concert, as they did during the Great Recession, that big drop on the right, or with the Greek sovereign debt crisis, you have kind of in the middle of the chart where Europe pulled China down. Now, when I think about the pricing of Ferrous, when I think about the pricing of most commodities, I think of the world as a global supply chain. The United States, 70% of the economy is consumption. Europe, also heavily consumption-based. That's what we do. We consume. China makes what we consume, and China consumes raw materials to do it. So if Europe is flirting with recession, or Europe hits a brick wall, China hits a brick wall, and when that happens, industrial metals prices do too. These are the most important and most time-sensitive pieces of data you can look at. If you look at GDP, for example, for the first quarter right now, January through March, the number's not even out yet for the U.S. It'll be out at the end of this month, and then they'll revise it a couple more times. And just before Q3, you'll know what Q1 was. That's not very helpful. But if you want to know where industrial metals prices are going, these are the numbers to watch, and I'll show you why. And this is perhaps one of the most telling things, because this is the Eurozone, and you can see the big blue bars here were the recessions, the two dips that they had, the financial crisis and then the Greek sovereign debt crisis. And in October, when I was in Europe, I was very frequently asked at LME Week about the prospects of a triple dip recession. And that was the risk, but now that the quantitative easing program's been implemented, you can see on the far right of the graph, it's bounced above 50, indicating that Europe's growing at least a little bit. The IMF data that came out just last week, forecasts were actually revised a little bit down for the US, still expecting 3.1% GDP. But for Europe and for Japan, we're revised higher, effectively calling a bottom for what's going on in Europe and in Japan. That's going to be positive for industrial metals. It's going to be positive for Chinese growth, but there's a lag effect. So when I think about prices, I think it's important to think about what happened in the last year, because we think about those PMI graphs, everything was going relatively okay in the economy. And then in the middle of last year, the global economy hit a brick wall. Now, I hear a lot of folks in oil and gas and in metals, they talk a lot about oversupply, and that's a huge problem. And when we look at this graph, there's three lines. These are the NYMEX contracts. The blue line is hot rolled coil. The red line, which is at the bottom, that's iron ore, and the line in between, of course, is the busheling NYMEX contract. And you can see that, except for iron ore, which was falling earlier in the year, a little bit before the middle of the graph, you hit the mid-year, and by the time you hit the fall, you've got still further moving down iron ore prices, and by the mid-year, by the beginning of this year, then scrap and steel started falling sharply. Now, what I've done here is I've based all the prices so that you can see kind of what I think about, maybe give you an idea of what my thought process is. I based everything at 100 for January 1st of 2014. So this is not the actual price traded on the market. This is if we indexed everything back to Jan 1, 2014. And the reason it's important is because when I do the same to the PMIs, and we have our own sort of weighted internal PMI we look at, we take China, the US, and the Eurozone, which are the three biggest economies in the world, and we plot them on a graph, and we plot a weighting of those purchasing manager indices, those surveys of real folks at real companies that manufacture stuff, and we ask them, are you growing or are you contracting? This is what we get. So the 100, again, it doesn't represent growth or contraction. It's where we were on January 1st, 2014. And actually, for the PMIs, it's actually December 31st of 2013. But it's essentially the same thing. And what you see is everything kind of goes okay until the mid-year. The PMIs fall quite sharply at the mid-year. They hang out at low levels, and eventually steel and scrap prices get pulled down. And there's a lag there, and there's a couple things. So while iron ore has been impacted by a capacity issue for steel and scrap, which also have some capacity issues, although I would argue not as great, what the problem here is the broader slowing in the global market helped to pull that down, and there's a lag effect between the slowing and some of the price action. I would back that up by showing you this graph, which does the same with copper and oil. And the copper line is the purple line that moves relatively flat, and the oil price is the orange line that falls and then rises with this global PMI. And that blue line, that thick blue line, that's that 100 base as of Jan 114. That shows us it's contracting, it's falling, it's weakening, and now it looks like it's bottomed and it's gone up a little bit. We're still nowhere near where we were at the beginning of January, but it has improved. Again, if we wanted to see that sort of without the copper and without the oil, you can see here there's a multi-month lag for the busheling contract and for the HRC contract. And the reason that is because of how they're traded. They're not as liquid, which is why for something like copper or for oil, they rebound more quickly because they're much more liquid and they have a forward curve that you can trade in the future. And in a very liquid way that has feedback to the present. So when you're looking at these prices, not only are they affected by the present, but they're affected by future expectations, which is less common for the busheling contract, which is less common for the HRC contracts. So in short, I expect that the prices will rise from here, but there's going to be a lag, and it's going to take some time before we get to where we were a year and a half ago. These are our price decks, so we see prices a little bit higher next year than this year lower than last year, and prices next year looking a little bit more similar to 14's levels, but still soft. It's probably not until the end of 2016, a year and a half from now, where things begin to look more like they did a year and a half ago. There's going to be a slow claw out for the global economy. You see both across the globe, all the accommodative monetary policies that are in place. These are supportive of growth, but there's a real lag in how quickly that has an impact. I'm just going to quickly run through some drivers, and then we'll get to the Q&A and the discussion, because that's what really is important. As for drivers, if we look at where steel consumption is, the biggest categories are construction, their automotive, their machinery and equipment, and their energy. And I'll talk about these in just a second. There's good news and bad news for what's going on in steel markets. And this has a huge impact aside from sort of the technical, monetary policy, directional movements of PMIs. This gets it to one level deeper, right? The U.S. economy is expanding. We see continued job growth here. That's good for consumption of durables. That's good for consumption of autos, which is a huge part of steel demand. Those auto sales, they are rising. Interest rates, we see them remaining relatively low, and long-dated debt rates are likely to be low, which is positive for construction, and that's true domestically as well as internationally. We see machinery and equipment demand that should remain solid domestically, even though it slowed somewhat in Q1. It should be solid moving forward, and we see it improving internationally. The monetary policy that we see out there right now in the first quarter, you couldn't go a week almost without some central bank doing something crazy. The Swiss National Bank lifts its cap. The European Central Bank implements $1 trillion+ in quantitative easing. The Swedish Riksbank, the Swedish Imperial Bank, they cut to negative repo rates. You not only had negative deposit, this is a negative repo rate. You had the Russian Central Bank cutting. You had the People's Bank of China cutting. And by the way, the People's Bank of China will cut until more growth comes. That's why this weekend they cut. And it's not like the Fed, where the Fed says we're going to have at a meeting sometime soon, we'll mention at what future meeting we might think we'll be maybe raising rates. The Bank of China on Saturday night said, you know, we're gonna cut rates tomorrow, and they did. So that's a little bit more proactive. You're going to get a little bit less of a time lag, and I think there's upside from here. The Eurozone's also likely past the bottom. That's the upside. For the downside, it's even not fully downside, right? All the central banks have already recognized there was a downtime, and they're pushing it forward. The global economy is slow, but it's likely to be stronger later this year because of those monetary policies. We see some domestic substitution for autos to aluminum, but globally, we just see a rising auto sales as a secular phenomenon. That's going to be still really positive for steel demand. And while U.S. oil and gas has slowed and has negative implications for tubing and pipe demand, infrastructure needs are wildly high and a much bigger deal. And by the way, oil prices, there were a lot of guys who were saying $40 forever earlier in the year. I was not one of them. So while we did expect the first quarter prices would be very low, we expected a recovery, which we're beginning to see now. And it will be gradual, much like what we'll see in the metals markets, but it's driven by what goes on in the global economy. The demand side has a huge impact on where prices end. So I'm just going to run through a couple quick graphs. This is private non-residential construction, and it's been rising, but what you see here, that big bump, that was the peak of the last cycle. We're not there yet. There's a lot more upside for construction. We personally are forecasting that we'll have good U.S. growth for the next 24 to 36 months. That's conducive to continued construction, as are low interest rates, which are low not only here but everywhere. Good for steel demand. Auto sales, rocking and rolling. Now, I can tell you a secret because I do modeling for the auto sector. We have a number of different auto industry groups and auto clients, and I can tell you what drives auto sales. There is a statistically positive correlation with real per capita GDP and an inverse correlation with the unemployment rate. In other words, more people with more jobs making more money buy more cars. Don't tell anyone. So, but things are good. We're going to see more job gains. That's going to be positive, right? As for crude oil, yeah, prices likely bottomed in January. They're going up from here. There's not only been a supply response where oil and gas companies, they've cut their demand for tubing, for pipe, for everything else, but there's also a demand shock where if you look at the percent of light vehicles being sold now, it's the light trucks and SUV sales are through the roof. And the miles driven numbers are at the highest levels in a decade on a year-over-year percent change basis. So you're looking at big upside for auto consumption, for oil consumption, and that's going to be good for prices. And of course, then there's energy infrastructure. This might be tough to see, but there's so much required for pipelines, for gathering, for processing, for gas and oil. This isn't the downhole tubing stuff. This is to mitigate the fact that one day, last year in the spring of 2014, early, it was in February, I believe, the price of natural gas on the exchange was $5. And if you went to buy it physically at Henry Hub, it was $8. And at Chicago City Gate, it was around $45. And in New York City, it was around $132 for the same amount of gas. And in North Dakota, they were flaring it. They were just burning it. That's a really big arbitrage opportunity. If it's $132 in one spot and you're burning it for nothing in another, and that is one of the factors that will drive infrastructure, as are LNG export terminals. There's a lot of metals going into that. That's all pretty positive. Now, the last thing I'm going to talk about, because I know we will get into this in our discussion of Q&A, I just want to point out these graphs. I often have discussions about quantitative easing, but I really want to point this out for the regional dynamics in the country. This is the two-speed American economy before QE3 was implemented. The red shades from pink to red represent unemployment rates above 8%. The brightest red shades are on the West Coast, where California was above 10% and Nevada was above 11% for unemployment. The Southeast also had a big housing boom, had a big housing bust, a lot of unemployment rates above 9%. The Rust Belt, the same thing. The auto sector was really hurting. Again, high unemployment, major driver, right? And the financial sector as well. But now that quantitative easing has passed and the U.S. economy is on a gradual improving basis, you still see some problems in the Southeast and Southwest compared to, say, the energy corridor or in the D.C. area, the seat of power. But what we see also is that there's still some difference in the speed of growth. And that's something that drives some of the supply issues from a scrap standpoint. If you're in an area with very high unemployment, and it's been that way for 5, 6, 7 years, you begin to have a problem generating supply of scrap. If you're in an area that's hot, 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 and you're generating a lot of scrap because the unemployment rate is below 5%, then there's more supply in that market. And I'm sure we'll get into those issues in a minute. I won't really review the points. It's been such a short presentation. But if you have any other questions, please feel free to ask us while we're here in the panel. Email me personally, and thank you very much.
Thanks, Jason. I guess this works. I don't have to walk way over there. Thanks, Jason. I appreciate it. So Jason is going to, kind of gave a longer presentation. I'm going to have Michael and Jim, they're going to just say a few opening remarks, and then we'll really get it open to questions because we really want to, have an interactive thing. But right now, Michael Kozlov, who's going to speak next, is one who really built Tube City, as you guys know. I think that I had one of the guys from Houlihan Lokey told me he'd never seen anybody sell a business as many times as Michael. So I think I asked Michael, how many times did you sell this business? He said 10. So 5, is that what you said, 5? I think he said 10. Yeah. But anyway, I'll let Michael tell a little bit more about himself.
Thank you, George.
Thank you, my friend.
What the hell's all this?
Well, we lost our.
Here, let me just stick it in my pocket.
Okay.
Well, I don't have any slides or anything because I've always operated from observation. And even though today I'm observing from 11,000 feet, one thing I did observe today, that I see everybody on this panel in a coat and tie and socks, and I'm the only one without a coat and tie, without socks. I'm also the only one out of a job. So anyhow, first of all, thank you to the ISRI organization, to George, Robin, to Doug, Kendig. It's really fun to get back. I haven't been here in a long time. It gets me off the golf course for a few days, which is great. What has impressed me the most about what I see here is something has not changed. It seems to be the core of this business is still the independent scrap dealer. And I would hope that that always continues. And even though we're in tough times, I see the resilience, and that hasn't changed. I don't see people turning over. I don't see them going bankrupt so fast. I see them surviving. And the survival instincts in a commodity market, when conditions change all the time, I think it's great. Many of the pieces of the supply and demand equation are affected fundamentally, but it's really the same because cosmetically, only things have changed. For example, we changed from the open hearth to electric to DRI to things like that. But by and large, the fundamentals of this business have not changed one iota. I congratulate you all for staying the course, for doing what you have to do. And in the question and answer period, we'll talk about why I think things are going to pick up. So thank you all very much for having me.
Thank you. Okay, last but not least, Jim Wiseman is going to come up and he's going to give a few opening remarks, and then again we'll do questions and get the audience going.
Thank you, George. I'm the comic relief in this group here. I also want to thank ISRI for giving me the opportunity to speak on this panel. And I'm just going to make a few remarks because these guys are, some of their qualifications are far beyond mine. I've just been a scrap guy for 37 years. I'm with Smart Recycling Management. We're based out of Lexington, Kentucky. So anyhow, I've got a couple of things. One of my first points would be that obviously this is a cyclical business that we're in, and we're in one of those cycles right now. And it's a downtime, but in the time that I've been in this business, we've always gotten through these times, and the downtime will go away at some point, and we'll have downtimes and uptimes to deal with in the future. But in addition to the typical aspects of this downturn, there have also been some unusual complicating factors as well. Typically, at times like we have right now, demand slackens, and we see falling prices and production cutbacks that eventually lead to a market rebalancing and recovery. And prices have certainly come off in the last, particularly in the last few weeks. I mean, scrap grades down 30, 40% from this time last year. So on the production side, we've also seen domestic mills idling capacity, and it's brought the utilization rates down below 70% in some areas. But the atypical factors associated with this downturn are making matters a little bit more complicated. Chief among those factors is that iron ore production is still ramping up, and